The best single thing you could have done.
How should you invest as we head into 2023? It's a question I'm sure you've been thinking about recently while watching the stock market collapse, cryptocurrency in freefall, and the property market beginning to reverse course. Financial markets have been an absolute bloodbath in 2022 on the back of some of the highest inflation in 40 years, an oil and energy crisis, large military conflicts, and rising geopolitical tensions. But have we turned a corner? Inflation has been easing, energy prices are coming down, and markets have been booming over the past few weeks. So in times like these, we can turn to the greatest investor of all time, Warren Buffett, to learn how he approaches investing. And today, not only am I going to share with you Warren Buffett's own investing strategy, but also another strategy that is easy to execute and that Warren Buffett recommends for the average investor.
And my circle of competence doesn't include the ability to predict interest rates a day from now, or a year from now, or 5 years from now. So I say, can I function without knowing that?
The most important first step is to recognize that it's impossible to know what the economy is going to do in the short term. There are all kinds of events, good and bad, that occur over a week, a month, a year, or even a couple of years that are unpredictable and have unknown consequences on stock prices in the short term. And this year, there's been no shortage of these short-term unknown factors. We've had military conflicts, geopolitical tensions, inflations, an energy crisis, and most recently, a cryptocurrency financial crisis. So knowing that these kinds of short-term events can pop up at any time, we need a method of investing that allows us to ignore the short-term macroeconomic problems, but still do well over the long term. And that method is to invest in companies that we're extremely confident will still be thriving in 10 or more years down the road. And Buffett says that there are 3 key elements that we need to look for in these companies. So let's start with the first element, investing within your circle of competence. Investing is a game with no called strikes. And if you're Australian like me and didn't really know what a called strike was, well, it's a term in baseball that refers to when a ball is pitched in the strike zone and the batter doesn't swing. It's a strike, and 3 of those strikes and you're out.
And in investing, I'm in a no-called strike business, which is the best business you can be in.
There is no punishment for not swinging in the investing game. You can watch stock after stock fly by you and only swing at the ones you're extremely confident you will do well in.
I can look at 1,000 different companies, and I don't have to be right on every one of them or even 50 of them. So I can pick the ball I want to hit.
Buffett has made a fortune on the back of a handful of key investing decisions over many decades. And the 2 lessons from that are that you need to be patient enough to ignore most stocks, and you also need to know when to hit.
And I do know what I call my circle of competence. So I stay within that circle, and I don't worry about things that are outside that circle.
My actionable tip for this section is that you want to stay up to date with the operations of many types of businesses. By doing this over time, you will gravitate towards learning a lot about certain types of businesses and certain industries where you're really interested and can learn how those businesses work more easily than other industries. Remember, it doesn't matter how wide your circle of competence is. What matters is knowing where the edge is and making sure that you're always investing well within that circle. One fantastic resource for keeping up to date with the markets and individual companies is the sponsor of today's video, Seeking Alpha. Seeking Alpha is a massive online community of stock pickers, and the premium plan has a ton of awesome features. Expert analysis and news for thousands of different stocks to help you learn the ins and outs of what's going on in companies and the economy. You can import and track your own portfolio, including buy or sell price alerts. There are consensus buy, hold, and sell ratings from members, Wall Street analysts, and even Seeking Alpha's own algorithm. You can screen for stocks using a variety of fundamental and technical analysis metrics, access up to 10 years of financial data and company filings. There's also a ton of educational content to improve your skills, including webinars, podcasts, and articles. And best of all, if you use my link down in the description below, you can sign up to an annual plan for as little as $8 per month, which also comes with a free trial, so you've got absolutely nothing to lose by checking it out. So head over to hamishhotter.com/Seeking Alpha and try Seeking Alpha out today.
What are the key indicators you look for within companies before making an investment?
Well, I look for something that does give them a moat around it.
The second element of a great company is one that has a wide and deep economic moat around it. An economic moat is simply a unique competitive advantage that allows a business to thrive over the long term. And there are many different forms of economic moats that companies can have.
It can be because it's the low-cost producer in some area. It can be because it has a natural franchise, because of service capabilities. It could be because of its position in the consumer's mind. It can be because of a technological advantage.
Some key types of moat include a brand, brand or some other kind of intangible asset such as a patent, economies of scale, switching cost, toll bridge, network effect, and counter positioning. The thing to recognize that almost every company you come across on the stock market will have some kind of moat. For a business to even list on the stock market and have at the least millions, but maybe even billions of dollars in revenue, they've already got something unique, some kind of moat that's allowed them to scale more easily against the many other smaller competitors across the whole of the United States. So it's not just about figuring out which company has a moat. Most of these businesses will have moats. It's about figuring out which businesses have moats that are likely going to be sustainable over time and provide a strong enough advantage to fend off all competition.
And most moats aren't worth a damn in capitalism. I mean, that's the nature of it. And we are trying to figure out why is that castle still standing?
For example, a business that's selling physical products that sells slightly more volume than its competition likely has some scale economic advantages because they're selling more volume, so their unit costs are likely a little bit smaller. That business has a moat, but it likely isn't a sustainable advantage because if they only have a slight scale advantage, then it can be relatively easy for smaller businesses that are just slightly smaller to lower their prices, to take market share, and to scale quicker. So that's what a moat is, but what is it exactly that the moat is protecting? What's the castle that it's protecting? The characteristic which businesses want to protect is the ability to produce high returns on invested capital over the long term.
A good business is the one that earns a high rate of return on tangible assets.
Very simple.
That's pretty simple, yeah.
Every type of economic moat essentially helps the business to maintain high returns on the capital that they invest. Take a brand moat, for example. If a company has a powerful brand, they can charge customers more than competing products, which likely cost the same amount to produce. Identifying deep economic moats is about figuring out what are the key indicators of that particular business or industry that make it likely that that business is going to maintain its competitive advantage. And these key indicators differ from different industries and different businesses, as well as for different types of moats. For example, Coca-Cola's brand power is demonstrated by their ability to raise wholesale prices with zero resistance from retailers who essentially know that their customers won't substitute the drink for a different brand. Only by investing in businesses with deep economic moats can we be confident holding them through tough economic times. Now, as I mentioned earlier, if digging deep in companies and looking at competitive advantages is something that you are not interested in doing, that's okay. There is another easier method to executing investment in the stock market that Buffett actually recommends for the average person. I'm going to talk about it a little bit later in this video. But first, Buffett's third key element is management.
Yeah, well, we love managers that have a passion for their business. And when we're buying a business, we have to ask ourselves, do they love the money or do they love the business?
As an outside investor, we rely on a team of executives to manage the business with our interests in mind, to be honest with us about what's going on in the business, and to ultimately be skillful, be good at their job. While of course a large part of a company's success hinges on its economic moat and its core product and services, it also depends heavily on the decision-making of the people running the company. First principle within management is to distinguish between a CEO who is passionate about growing the business long-term and one who is really only there to serve their own self-interests.
The entrepreneurs probably, on average, would have a significantly greater degree of passion for those businesses than somebody that was just brought in a few years ago. We've had terrific luck with the entrepreneurs. They are not going to let anything happen to their businesses.
Of course, a passionate CEO is fantastic, but beyond passion, they also need to have a proven track record of actually being good within the business. And when I say skill, what I'm talking about is really two categories: debt management and capital investment. So first of all, we're looking for a management team that keeps the business in strong financial health, keeps debt to a low level to reduce the risk for investors in the business, and also a management team that has shown their ability to make really good investments in the business that generate high returns on capital. Some investors seem to think that it's a disadvantage to be a retail investor who can't access the CEO personally and interview them, but Buffett really doesn't see it that way.
And we've bought many things without meeting managements at all, having any entree to them.
In fact, Buffett often finds it valuable to actually keep some distance between himself and the management team. The reason for this is it's really easy for institutional investors to get emotionally attached to a CEO who, in many cases, will be very good at marketing themselves and the company to the investors, and it's very easy for those investors to get kind of swept up in the emotions rather than staying rational about whether that management team is actually good for the company. So how can you actually analyze management from afar?
But in terms of marketable securities,
We read the reports. Now,
Buffett is looking to see if management is honest and transparent about the key metrics for the business. If management ignores important indicators and tries to get investors to focus on other things that don't really matter, it's a clear indication that the management team doesn't know what they're doing, or at the very least doesn't really care about being transparent about what's happening in the business.
and you can't find in that report what their finding cost per MCF or per barrel of oil was last year. That's the most important figure. The reason it wasn't discussed, it was absolutely terrible. But the fact that it wouldn't even be discussed, and to the extent it was touched on, it was done in a dishonest manner.
Annual letters to the shareholders, management discussion section of annual reports, and the quarterly conference calls are all great ways to assess the management team. So those are the three elements of a great company, but there's a big difference between a great company and a great investment. Essentially, the first three elements we've spoken about lead us into companies where it's easier to do the final fourth section, which is valuation.
The only reason for making an investment and laying out money now is to get more money later on, right? That's what investing is all about.
Investing is a game of outlaying cash today to receive more cash in the future. The cash that we outlay today is the stock price, what we have to pay for the stock. So we essentially need to estimate what we can get back from that business while we hold the stock. And we do this by doing a maths calculation called a present value of cash flows. You can do all of this fairly easily in my stock analysis spreadsheet, which is linked down in the description below. And when I say easily, I mean it's easy for you to enter in the numbers and calculate what range you would be buying a stock at. But in terms of actually coming up with a future projection, it is extremely difficult and something that needs to be done a lot of times to get good at. Even though this is the strategy that Buffett uses himself and says that is still a viable strategy today, he thinks for the average investor, there's actually a better way you can go about it.
Some people should not own stocks at all because they just get too upset with price fluctuations. If you're going to do dumb things because a stock goes down, you shouldn't own a stock at all.
The reality is that it's very difficult to execute Buffett's strategy without extreme commitment and great temperament. You need to commit to finding and analyzing companies over many, many years, and at the same time, you need to be able to be emotionless when it comes to your investment decisions, and that's something that's very difficult for most people to do whose livelihood relies on their financial decisions. But there is an alternative that Buffett suggests.
The best single thing you could have done on March 11th, 1942, when I bought my first stock, was just buy an index fund and never look at a headline, never think about stocks anymore.
Broad market tracking index funds in the US have done tremendously well over many decades on the back of a country that fosters an environment for businesses to compete, innovate, and to become more productive. So while individual companies rise and fall all the time, as a group, the basket of the biggest companies in the US have risen over time. And this helps to take a substantial amount of the emotion out, because instead of having to bet on a handful of individual companies and whether they'll succeed, you essentially just have to bet that the US economy will continue to be a powerhouse and thrive over time. There's no certainties in anything, but Buffett believes that it's likely the US continues to grow over the long term.
You didn't have to worry about what stock to buy. You didn't have to worry what day to get in and out. You didn't know the Federal Reserve would exist. Whatever it might be, America works.